All right, guys, we are, what is this, episode 4? Episode 4, guest 3. We have Aaron here. You're the owner of Spectrum, aren't you?
Yeah, I'm one of the partners.
Yeah, one of the partners, yes.
Yep.
Aaron is actually my accountant. He's probably going to be one of my favourite guests so far for this year, for the pure fact of that I have gone through a lot of accountants in my life as a business owner, and Aaron is hands down the best of the best. So everybody meet Aaron. Aaron, everybody.
Hello, everybody. Glad to be joining you on episode 4.
Yes, guest 3.
And I'll be the best guest so far.
That's right. That's right.
I had a 33% chance of being the best guest. So.
Yeah, there you go. So I think we'll start off with talking about why it's important to have an accountant, and when do you feel that it's important for a small business to be able to have that option available to them instead of them doing it themselves, and why you would at what stage do you recommend that people should have an accountant, and what is the difference between an accountant and a bookkeeper, just so everyone's aware.
Okay, so packaging a lot in there.
Okay, go for
it. We'll digest that down. I think the easiest way to explain, and we'll try and explain everything in fun terms a bit later. I mean, talking about accountancy for an hour or so may put a couple of people to sleep. So hopefully not. Stay awake, crew. But we'll try and make it as interesting as possible. To simplify it, a bookkeeper records the numbers and an accountant interprets the numbers.
Okay, cool.
You know, accountants have that higher level of, I guess, knowledge and experience.
Yeah.
We need to be able to take what's been put down, make sure it's correct, analyse it, and then provide you with feedback as to what it's actually saying.
Yeah.
So, I mean, your question about when should a small business engage an accountant from day one.
Yeah.
From the moment they're thinking about it. I mean, we are engaged pretty much from the start, simply because most people into small business are going into it in some type of structure. Yeah. Be it a company or a trust, or you know, you don't want to be doing business as an individual generally, because there's risks associated with that, which we can talk about in a later question.
Yes, that would be really good, actually.
But and from some of your experiences in the past, you've seen the advantages of being in a structure versus being individual, and how you know you can protect certain personal assets whilst doing that. But yeah, so usually from day one, people will have to engage us, and then from there, it's we then walk them through the establishment phase of the business. Yeah. And then hopefully, you know, they take our advice on. And then from there, we're just basically part of the hand-holding through their initial learning. Because there's a lot of people going into business, they're new. Yes. They don't understand the ins and outs. And that's right. You know, some of the stuff we'll talk about in relation to where people go wrong is potentially because of a lack of understanding. Yeah. You know, I think
that's absolutely what it is.
Australia are devoid of financial literacy, especially in schools and whatnot. Like we don't educate these things. No. And it's probably one of the most fundamental principles of life, because everything comes back to money. Yeah. You're seeing it right now. Yeah. Like what's happening with the fuel strike and everything like that. It's all coming back to money. People want to work from home now because all of a sudden extra $50 a fortnight's going to their fuel car. So everything comes back to dollars and cents. And that's what we do. Yeah. We do numbers.
Yeah. Because like everybody can go and start a business, but at the end of the day, if you don't have that structure set up from the beginning, and the reason why I wanted Aaron on here and why it's so important to be able to explain to small businesses who haven't incorporated yet to a P2I Ltd is having a good accountant from the beginning is so fucking important, because if you don't, for me, for example, I did not, you end up making bad choices and ultimately you end up in debt to the ATO if you don't have a proper structure set up or your business isn't aligned properly. So for me, that's what happened. And then I ended up obviously going to Aaron and sitting down and having a conversation, and we've had some really tough conversations. Like I've sat in Aaron's office in front of him and cried, and I could see how uncomfortable he was when that happened. But for me, it's super overwhelming. I couldn't wrap my hand around it. I was just hustling, and nothing was coming out of that hustling, and it was such a struggle. And he literally just said to me, you just need to keep pushing through, keep going. Let's recheck in 3 months, 4 months, 5 months, etc. And then I made it out the other end, which is great. But without that advice and without, honestly, you having to sit there and you and your team really sit there and go, you know what, if you keep going, like it'll eventually, you're going to get there. Without you guys saying that, I probably wouldn't be where I am today. So I appreciate you and thank you for that, for just giving that little tiny bit of advice and, You know, I've had a few kicks up the bums from you and the girls of like, you know, this is what you need to do, and it really has helped. So I appreciate that. But it is so important to have a good accountant from the beginning. Really, really important.
Yeah, I think so. And whether it's us or anyone in the marketplace as well, once you find a good one,
that's right.
generally try and stick with them.
Yeah.
And I think a good accountant will never, like you hear these buzzwords like proactiveness and everything like that. And I've been around 28 years now in the accounting game. We have, you know, somewhere between 800 and 1,000 clients. So it's pretty for a team of 15 or something like that. So we work really hard. Our proactiveness comes from it's an interesting thing to say proactiveness, because we're not there monitoring every individual person and say, you should be doing this, should be doing this. Yeah. The proactiveness comes from we understand the rules. We communicate a lot via our social media channels. Whenever new information is coming out, like Payday Super comes out in July, we've been trying to be on the front foot of all that. We try and be on the front foot of where there is industry change. And from there, then the client comes to us with their questions of how it's relevant to them. So we give the information broadly and then try and work it down specifically. The proactiveness we come from is more around opportunities for strategy. So if we see, and I mean, we do about 500 activity statements for clients for quarter, which is another thing, another service that we offer, like which we'll talk about GST and all that shortly. But that's a good point of contact for us in relation to be able to see how businesses are performing. Because then we can go, all right, you're having a good year, we recommend this. You're not having a good year. We need to think about things. You're paying instalment tax based on a year that was lower. We anticipate you're going to have a higher amount. Start planning for that. You're paying too much instalment tax because you had a one-off event. Things have changed. You've consolidated. You've done a few other things. You've invested money in your company. We need to lower that. So that's where I think, you know, those contact points every quarter is a good basis. And yes, that costs money to the client, but the thing is getting the value. The question you said about why should you have an accountant rather than doing it yourself? A lot of people try and do the bookkeeping themselves, and I get that. And, you know, once they learn the fundamentals of that, it's like an 80-20 rule. If you can do 80% and you need us just for the 20, that's fine. But I put it akin to, you know, your business is an investment. Similar to us buying a motor vehicle is a purchase. I could try and do the servicing myself, but I'd have no freaking idea how to do it. Or I'd ruffle, okay, this is oil, and I could go on the internet and go, oh, you should be doing this and whatever else. There's no guarantee, one, I'm going to do it right, and I'm going to be nervous I'm going to get it wrong. And then I'm going to do a bigger damage, and then in the end it's going to cost me 3 times as much to fix it. Same principles apply in financial management. You do it yourself, but you don't have the knowledge and experience. Somewhere down the path you may do something that you didn't know you did wrong. Government comes knocking, and all of a sudden it's going to cost you 3 times as much to fix it.
I just feel like from day dot, everybody should have an accountant. You shouldn't be trying to do. I've never done any of my bookkeeping. The girls do it. I reconcile the accounts, but if I was to do all of that and then try and run a business at the same time, for me, investing my time into the business to make it grow or pay someone to do the accounting and make sure it's done properly every quarter, etc., is worth. And to be honest, you guys, I find you guys extremely affordable. I find the fees that I pay you guys, it's manageable, it's easy, it's not over the top, it's not like I really think you should increase your prices, but please don't.
No, 90% of our 90 probably a bit high. Most of our fee base ranges from $3,000 through to $6,000, like for a one entity structure. Which equates to around $500 a month, and it always varies like that. But that's at the top end. You've got more structures, obviously increases. But generally speaking, if you've just got a single structure with your 2 individuals, that $300 to $400 a month is a good investment for getting everything right.
Absolutely.
And it turns out, that's tax deductible. You get the GSTs back. So your actual cost is, 60%, give or take, of that actual cost.
Which is nothing.
So the government pays 40. And then you're paying the other 60. But for that, you're getting the knowledge and experience that you need to be able to make fundamental decisions. Because we always say that if what we know and how we can help your business, you'll save in what you pay us.
Yeah, absolutely. And there's so many times where Going back to previous accountants that I've had where I've emailed them and I've never got a response, or I've called and no one's ever called me back, or I call and I feel like I can't ask those questions because I don't want to look dumb. And that's just the reality. Like even Gemma will be like, oh, I don't want to ask the accountants this. You know, I feel like it's a stupid question. And I'm like, this is not a field that we play in. We don't know this. We know credit repair, right? This is what we're good at. Ask the question. The girls are going to probably write back and be thinking, oh my God, that's such a dumb question. But for us, it's not something that we know, like we don't learn, as you said, there's nothing in school that teaches us about this. There's no platform for us to learn this. We have to trust and be guided by you guys to make the right decision, for us to be educated off what you tell us. And so many times I felt like I can't reach out to my previous accountants and ask those questions, but every single time that I email you girls or Gemma emails you or whatever, you always respond literally either same day or next day with a plan, or like, hey, let's chat about this, or let's do this. And it's so much relief as a business owner to be able to have that option, because a lot of people don't.
Yeah.
Like a lot
As
of
a
people
firm, we
don't
like to
have
think
that.
we've got a good team. So,
Yeah. Oh, you guys have the best team. I love your girls.
We
They're the
pride
best.
ourselves on fast communication and return of service in urgent matters.
Yeah.
And we do get quite a lot of the old this is urgent scenario.
And it's not.
Hey?
And it's not urgent.
Depends. But that's how the industry has changed. We used to sit in the back corner. You'd give us the stuff. Prior technology, you know, it'd be a handful of green cash books.
Yep.
We'll see you in 8 weeks.
Yeah.
Now it's like the bank needs this.
Yes.
You know, an investor needs this.
Yeah.
The ATO are calling on relation to this. DPN notices have changed the game in relation to ATO debt for company directors.
Yeah.
So all of a sudden things have been brought forward a lot. You know, online accounting packages like Xero and that have also, you know, sped up everything. So clients are now a lot more hungrier for, well, they're not hungry for information, but, you know, and banks are a lot more savvy now in relation to finance. A lot of our questions and queries come from clients wanting finance, and that's why you need your accounting records up to date.
That's right.
So leaving it to the end of the year, you want to go get a home loan.
Yeah.
You're waiting an extra 4 weeks because you weren't up to date on things.
Yeah. Okay, so when would you suggest the best time, like when, I know that you said from the beginning, so as soon as someone is on an ABN, you recommend that they have an accountant. Let's just say when would you suggest for them to register for GST and then incorporate to a P2I LTD? What would be your suggestion on that?
Every client is different and every circumstance is different. So the best thing to do is before you go into business is engage an accountant to go through your idea and identify what is going to be the best structure for you. So structure is one, but then two is to identify when certain things may have to take place by law or when it's best for you to do it. If you're going to be in business, the GST side, I've always recommended clients pretty much establish GST from day dot, simply because people don't understand the GST is twofold. And when you're in business, yes, you've got to charge GST. So whatever price you're going to charge, you've got to add your 10%. But you also get to claim the GST back on everything you spend. So if you're going to commence a business and you might want to buy a motor vehicle, you're going to have to buy some stock. You're going to have to invest in premises or anything like that. All those costs have GST on it that you could claim back.
So how does that work though with the GST refunds? Is that forever? Is that for a period of time from when they start the business? And how does the GST refund work, as in us as business owners getting that money back?
So it all depends. So your business activity statement is your fundamental statement for reporting GST. It's one component of what we call the business activity statement,
which is BAS.
BAS. Most people don't understand that when you're in small business, you're also a tax collector for the government. So there's generally two types of taxes you collect, and then there's one you pay once you've started making profits, which is a PAYG instalment. There are other elements to the BAS in relation to specific industries, but we won't delve into that today in 1 hour. But your fundamental components of an activity statement is GST reporting.
This is quarterly. You're talking about quarterly statements?
Or monthly. You can do it monthly, quarterly. You can even do it annually. But let's just assume 90% of businesses do it on a quarterly basis.
And this is only applying to people who have a P2I LTD?
No. It applies to anyone that's registered for GST.
Okay.
So if you're in business, whether you're an individual, a trust...
See, I didn't know that. I thought it was only if you were a P2I LTD that you would have to be... Yeah, okay.
No. So as soon as you get an ABN, then you've got to assess whether you, by law, have to register for GST or whether it's in your best interest to register.
And when
GST.
you're saying by law, that's you're talking about over the certain threshold.
Over the turnover. That's right. Which for profitable businesses, profit-making businesses, so anything but your not-for-profits, it's 75,000.
Yeah.
And for not-for-profits, it's 150.
Yeah. Okay.
So they're the decision-making tools. So when you start a business, you go, yep, I'm going to make 300 grand in a year. You should be registering for GST.
Mm-hmm.
So
yep, cool.
From day one. And your question about GST refund.
Yes.
Okay. So
sorry, I got off topic there.
Yeah, no, that's okay. So early on in your business establishment, there's a likelihood that you're going to spend more than you make.
Yes.
So at the end of the quarter, your accounting system, so taking one step back again, whenever you set up a business, you should then set up an appropriate accounting software system. Like we find in the marketplace, Xero is the easiest one to use.
Love Xero.
You've got Mob, you've got QuickBooks, whatever else. Don't go QuickBooks.
Yep.
And you can keep that in because it's horrible. But so Mob's not too bad.
Yeah.
Xero's the easiest, user-friendly. Absolutely. And they've put the reason Xero is probably the number one is they built it for an online basis from day one.
Yep.
The other two have come from desktop software and trying to incorporate into an online.
Yeah.
With limited success.
Yep.
Whereas Xero built theirs as a cloud-based system from day one.
It's very user-friendly.
Yeah.
Very user-friendly.
Yeah, it's very easy to use and very easy to understand.
Yeah.
From a client perspective. So by entering all your data into that, whether a bookkeeper that you engage, or if you're savvy enough to do the basic bookkeeping functions, your activity statement then every quarter, your software collaborates the information.
Yep.
And spits out the report.
Yeah, which is based off your bank statements.
It's based on your financial transactions, which incorporates your bank statements, but also for many businesses, they've got debtors and creditors.
Yep.
So, you raise an invoice, that's automatically a debtor.
Yep.
Someone sends you a bill that's not payable in 30 days, that's a creditor.
Yep.
So those three elements. So you've got immediate transactions.
Yep.
And then delayed transactions.
Okay.
With the GST system, many small businesses can register on a cash basis, which is different to how you report for income tax purposes, but that's a totally different conversation. Yeah. But basically the GST system for businesses with less than $2 million turnover is all based on cash. So cash in, cash out sort of thing.
So money in the bank and money out of the bank.
Pretty much, yeah.
Yeah.
So if you have a lot more money going out of the bank when you're starting off your business, and this is money that the business owner, has normally contributed from their own source of funds.
Yep.
In that first quarter, it's likely that you're going to have more GST credits than GST that you've collected off the people, public at large. So that's when you would have a GST refund.
Understood.
And you would lodge your activity statement. The ATO says, yep, you're entitled to a refund. They then pay it to your account.
Yeah. And when we're talking, so for example, we can obviously try and, for the example on a business structure would be the clinic, right?
Yep.
When I first opened, I obviously purchased a device.
Yep.
And then I purchased quite a lot of stuff during that period of starting the clinic up and fitting it out and all that kind of stuff. And I'm pretty sure, this was so long ago, but I'm pretty sure I got a GST refund.
You did?
Yeah.
You did?
Yeah. And we ran at a loss. Oh God, now I can't remember. I don't even want to think about it, but I'm pretty sure we've run at a loss almost every single year. There's been no profit margins.
Yeah, without getting too specifics in your circumstance, yours is an interesting one, the fact that you had two businesses running, one profitable, one not so profitable.
Yes.
So we managed the accounts for both of them so that, you were paying the lowest amount of tax. We were utilising the not profitable one, or utilising the enhanced depreciation because of the large amount of money you invested in your plant equipment to then offset your profits there. And we were strategizing that so that you weren't forking out unnecessary income tax, knowing that you were the ultimate owner of it. Because I think some people in business, whilst we talk about these structures and everything like that, in small business, it always comes back to the owner. Like, you could say, oh, my company owns this, or my trust owns this, or whatever. But at the end of the day, who really owns it?
Me.
The individual.
The
individual. So, when you get access to that is something we'll talk about later with that Division 7A word.
Yes.
But ultimately, if the business needs money, and in small business, you can't go to shareholders and say, give us more money.
Yep.
You can't go generally to a bank and say, I need money, because the bank's going to go, well, what are you going to give me as security?
Or you have no profits.
And you have no, and if you don't own property or whatever else, and you've got no profits, the bank's not just going to give you money. You're not going to give you an overdraft. So you're like, well, it's going to have to come from friends, family, or myself.
Yeah.
So ultimately, you know, and that's why initially the individuals prop the business up.
Yeah.
And then when it starts making money, they can draw the money back out again.
Yeah. Which I want to talk about, because just making sure that we've ticked everything off that we were supposed to talk about. So the GST refund portion, how that works is either you're entitled to it monthly or quarterly, depending on when you lodge everything. Is
depending
that right?
on when you register. Yeah. So you have the option. So say, for instance, you go into property development.
Yeah.
And you've got large costs, because a property development will be a hell of a lot of expenditure being funded by the banks.
Yeah.
And then there'll be one transaction, which is the sale of the property. You would want to be registered monthly to continually getting those GST refunds turned in.
Yeah, right.
And then when you go to sell the property, you're going to have the GST to pay.
Yep.
So, you know, the reason a lot of people don't lodge monthly is extra compliance.
Yeah.
Because you've got stricter deadlines and everything like that. But it's good for cash flow.
Yeah.
Because you've got your cash flow coming in and out as well.
Yeah,
like you don't have to then, which is where a lot of businesses go wrong, is they spend the tax money.
Yeah. Yes.
So
which we'll be touching on.
Yeah. So from that point of view, that's the reason why someone would register monthly, is they're constantly funding, you know, they've got a situation where there's a lot of opportunity to claim GST credits because there's a future transaction down the track.
Yeah, got it.
And property development's probably one area there that is popular for monthly.
Yeah, right.
Most of the time it's quarterly. But to be honest, not, you know, the majority of businesses will pay on their BAS every quarter. Yeah. If they're not, then no one's making any money. Yeah. And you should be paying. You should be, you know, collecting the GST, having it in a bank account, offsetting by any GST you've spent, and then sending that money off to the ATO. Yes, yeah.
And how do you think, what's a good appropriate way to be able to set up your bank accounts correctly so that business owners aren't touching that money that they're not supposed to? Because look, at the end of the day, I've been in a position where I've put money aside for tax or GST or whatever it is, and it comes to a point where I'm like, shit, I'm short this week. I have to pay X, Y, and Z, and then withdraw it back out and then top it back up. I find that that's pretty normal for other business owners that I know, where we pull them, especially because I've had two businesses. One's not making a lot. This business has been funding this business. Now that business is almost done, our profits are much higher. But is there any advice that you'd like to give small business owners on how to structure their bank accounts to make sure that when it comes to tax time, or, you know, give them a little bit of relief, you know, if you do want to touch that money, just make sure you're putting it back, or something along those lines, some advice there? Yeah.
The biggest problem is all money's touchable. So it doesn't matter whether you're putting it away into a separate bank account. Yeah. If you need it, you're going to grab it. Yeah. It comes down to understanding what percentage of money you really do need. Yeah. And in theory, the general principle is saving 25% of your profits. Yeah. And 10% of your GST. Yeah. Now that is, the 10% GST is overkill. Yeah. Because obviously you're paying GST back on credit. So your net GST usually ends up around 5 or 6% of your turnover. Yeah, right. Not 10% of your turnover. But, or 1/11 of your turnover. But the income tax side of things is a little bit harder to calculate. Yeah. Because you don't, in the early days, you may not know what your net profit is. Yeah. Which is why it's important for small business owners to understand how to read a profit and loss statement. Yes. Which is why it's important to understand, to have your financial records as accurate as possible and updated as regularly as possible. Yeah. So that as a basic principle of understanding financial information, any business owner could look at their profit and loss in their accounting file and go, I made 10 grand net. Yeah. 2.5 is tax. Even if it's not. Yeah. At least it's a general principle to say 25% of my profits I've got to prepare to give the government.
And you know what? It actually took me probably about 3 years to understand a profit and loss statement. Like, I just couldn't wrap my head around it. I didn't understand that I was only paying tax on my profits. I thought I was paying tax on my whole entire revenue. Like, there was, and for me, I don't know why, but I just couldn't get my head around it for years. I was like, I don't understand, like, how is this amount being calculated, etc. And it wasn't until I went to Aaron and the girls and I asked these questions and I was like, I just don't understand. Like, can you just dumb it down for me? Just like really specifically be like, okay, well, this is what you're paying for this. This is how this works, etc. But prior to that, I had no fucking idea. I had no idea. I was just making money. Money was coming in. Money was going out, and I had no structure, nothing. So.
And we get that a lot. We
Yeah.
get that, I've got no money, why
Yeah.
am I paying tax?
Yeah.
And that is the hardest question to try and articulate to our clients without, making them upset and trying to give them, it comes down to that lack of financial literacy of people.
That's right, yeah.
Because many people won't understand, and many accountants don't understand the correlation between the balance sheet and the profit and loss.
Yeah.
And understanding, okay, I've made $100,000, but I can't see any of it.
Yes.
Where's it gone?
Yeah.
And I could tell you in 2 minutes where it's gone.
Yeah.
You may not like the answers as to where it's gone.
Lani, you're overspending.
That's usually the answer we give.
Yeah.
It's gone to your personal
Yes.
expenditure endeavours, or it could be that it's gone to repayment of loans. The equipment that you got, and this is where the instant asset write-off was an absolute killer.
Yeah.
5 years ago. So
Yeah.
we always called it the tax holiday.
Yeah.
And we knew that at the end of the day it would come back to bite clients because they would never understand it principally.
Yes. Can you talk about that though? You're talking about when you purchase equipment or a car, like an asset, that there was a certain amount that was tax deductible, and then the year after that it lowered. Can you explain that? Because I'm obviously going to butcher it, but like, can you explain how that works and what it is now?
So that's you're talking about depreciation.
Yeah.
So up until between COVID and 30 June 2023, any asset you bought of any value, within any what we call the ATO allowable value, because motor vehicles, they limit how much you can claim.
Yeah. What was it back then? It was 60, wasn't it?
For a motor vehicle.
Yeah.
That's not a ute. Utes are a different kettle of fish, but a standard car.
Yeah.
That's why luxury cars are a terrible thing to buy from a tax perspective.
I
tell all my clients that buy the $120,000 Mercedes in their company that they can only claim 60 and half of it's dead money.
Yeah.
They don't like that.
Yeah.
Especially if they use it for private use, and then it's actually costing them the more than what it was to get the tax benefit. But once again, different story maybe for episode 15.
Yeah.
But, so what was I going to do? Where was I going to do? Depreciation.
Yeah.
So up until 2023, you bought an asset.
Yes.
You got to write all of that cost off.
Yes. And when you're saying writing that off, can you explain in layman terms what that means? Like, let's say company makes this.
Yep. So let's use a real simple example.
Yeah.
A company bought a $100,000 asset.
Yeah.
And it made $100,000 profit prior to 30 June 2023.
Yeah. Not revenue, profit.
Profit.
Yeah.
Okay. Before that asset is factored in.
Yeah.
So normally if you hadn't bought that asset, you would pay $25,000 tax.
Of the 100,000.
Yes.
Yeah.
At 25%. You've bought that asset, and prior to 30 June 2023, you could write that asset, expense that asset all for tax purposes.
Yeah.
So in the end, your taxable income becomes zero.
So you pay zero
So
tax.
you pay zero tax in that year.
Yeah.
But you have bought forward $25,000 of tax benefit.
Okay, explain.
Okay, so,
I'm like,
in a normal situation, all right, let's just assume that asset was available for deduction over 4 years. We'll use a really simple example.
Yeah.
So 25,000. So that asset itself has $25,000 of tax saving in it, because you only ever get, this is another thing people don't understand, you only ever get the tax benefit back of your expenditure. So for every dollar you spend in business, you save 25% in income tax.
Okay.
So because you pay 25% tax. So if you had a dollar profit, and you would pay tax at 25 cents.
Yeah.
So you would have 75 cents left.
Yes.
So for every dollar that you spend, you're saving 25 cents because you're reducing your profit by that amount. That's the general principle. So that's why we never buy anything just for tax purposes. Yeah. Because you're spending 100% of money, you get 25% credit from the government.
Yeah.
So you only ever buy things you need.
Yeah.
But yeah, so going back to that example, let's just say that in a normal world, that $100,000 asset was able to be written off over 4 years.
Why did they allow that though?
Why did they allow?
Yeah, is it still now? Obviously, this is going back from 2020 to 2023.
Yeah.
So moving forward from 2023 until now, do they still allow you to use that additionally throughout the years at a different rate?
So once you write the asset off for depreciation, once you've expensed it all for depreciation, you got nothing left.
When you're talking about depreciation, you're talking about over those 4 years.
Yeah, that's right.
Yeah, okay.
But up until 2023, the government rules allowed everyone to bring forward all that depreciation that you could claim over the future years into 1 year.
Okay.
So you're getting a tax saving then.
Yeah.
But what people didn't realise is that their profits, their taxable profits, were going to be higher in the next few years because they've still got the asset. They're still paying the asset off, but there's no tax benefit for it because you got it all in year one.
Okay. And then what is the option for us now in 2026 if we were to purchase something?
So for small business, which is who we're talking to, if you purchase something for $20,000 or less, you get to write that asset off immediately, which is a far lower amount, so that's a lot more manageable.
Yes.
You know, for any assets above that, you'll write it off over its useful life.
Yeah.
Every asset's different in relation to its useful life.
Yeah.
Or for small business, they've got the option of what we call pooling assets. But that's a bit of a technical area that we won't go into too much. Yeah. Most of our clients, for tax purposes, we would pool their assets because it's more advantageous.
Yeah. Okay. So 20,000. Let's just say someone bought equipment for 20 grand first year, and their profits that they made in the business, not the revenue, the profit was 20 grand, means that they don't have to pay any tax for that first year. Yeah. And then the second year, because for me, for some reason, I thought that the asset, you could still try and claim it for up to 3 years, but it was at a lower amount. Was that for something else? Was that the previous years?
That would be for assets that you haven't already fully expensed.
Okay.
So once you fully expense the asset,
you're talking about the full amount.
Yeah, the full amount.
Okay, so back to the 100,000. The first year was 25. The second year would be 25. Okay,
on a straight line basis.
Yeah. Okay.
But up until 2023, or nowadays with a $20,000 asset, if you expense it all in year one, there's nothing in year two. There's nothing in year three.
Yeah. Okay. Cool. I see. That's something that I couldn't wrap my head around either. I didn't quite understand how that worked. Okay. Cool. All right.
The other sting in the tail with that one was when people then sold that asset.
Why? What happened?
You pay tax on the full value.
Oh, right. I'm like, okay.
Because you've got nothing left. So in a normal course of event, if you're what we call written down value, which is basically the amount of depreciation you haven't claimed on an asset. Yeah. So if you had an asset of 100,000 and it had a written down value of 50,000 and you sold it for 50,000, there's no tax adjustment.
Yeah, okay.
But if you've claimed $100,000 of depreciation, so its written down value is zero, and you sell the asset for $50,000, you've got $50,000 of assessable income.
Yeah, right, okay.
Because you've claimed a full benefit, but you actually got refunded by another person.
Right, okay. That's interesting.
That'll be added to your assessable income and combined with your other income in that year.
Okay.
That was the big sting in the tail of this instant asset write-off is when these assets, which we're seeing now, are being sold and clients have forgotten the benefit they got 5 years ago.
Yeah, right.
And we're coming to them with once again, the negative news.
Yeah, shit. God, there'd be a lot. Because everyone went crazy when that came out.
Try dealing with a transport industry that bought $300,000 trucks and you got all the tax benefits then.
Oh, no.
And now having those conversations with the transport industry now where they're, as a guide, their cost of doing business has increased $800 a trip. Like for one client that I've got, we did some calculations. They're not making any money because of the fuel increase. And even though their suppliers provide a fuel surcharge, it doesn't cover the increased cost.
Who knows how that's going to all plan out. That's quite scary considering that we need transport desperately within Australia to transport everything throughout our country.
Unfortunately, as small people like us, we don't understand really the mechanics of what goes on behind the scenes.
Yeah.
We sort of just have to ride the curtails as I say. But from my perspective, I think I actually watch the oil price every night. I'm an idiot. But I would anticipate that if the war stopped today, you probably got 8 to 12 weeks of real pain.
Yeah.
Through
not forever.
deferred,
Yeah.
and then everything will subside and return to normal.
Yeah.
Or businesses that increase their prices now will generally keep their prices up because people could become used to them.
Yeah.
Economics is a totally different conversation that we'll talk about the other day, but fundamentally understanding economics as well as basics of economics is an important principle in small business as well. Just understanding supply and demand.
Yeah.
Because ultimately that's what everything's about.
Yeah.
You know.
Absolutely.
If there wasn't the ability to buy the product or service, then people wouldn't spend it. And then you'd have this changing mechanism of supply and demand.
Yeah.
So
it'd be, let's just hope that everything just stops. That would be fantastic. But it's going to be very interesting how long the repercussions will be, considering if it still continuously keeps going for the next few weeks or so.
And whether we learn our lessons after this debacle about
anyways, that's just
constant reliance on countries.
I know.
It takes 3 days to get here by ship.
Yeah.
So it's not a quick fix.
No, we're not going to be talking about that though. We're going to
stick to the
this.
positives.
Think of the positives. So I do want to touch on a Division 7A loan.
Yep.
And the effects if it's not handled correctly. And I'm going to touch on this in a different episode of the podcast on how this actually completely financially fucked me for about 2.5 years. And honestly, on the verge of just throwing everything straight in the bin and hiding because it was the most stressful, financially stressful. It was terrible. It was the worst time of my life. But I would love for you to explain what that is and the effects and how, if you do get to a certain point, how to manage it and not take the option that unfortunately some other accountant advised me to take.
Okay, cool. The first thing to consider with that provision of the law is that it only applies to companies.
Yep.
So it's only the company structure that we're dealing with here. How it comes about is one of the reasons that people do business in companies is the lower tax rate. Like it's a 25% flat tax rate. So we have this calculation that we do is at what level is the individual's average rate of tax? Because the individual pays tax at different rates depending on their income.
Yeah.
When is it that their average rate of tax equals the company tax rate?
Okay.
And at the moment it sits around 135,000 if the company is a company that gets taxed at 25%.
Okay.
There are some companies that get taxed at 30%, which then pushes the average rate up to about 160,000, give or take a few bucks.
Mm-hmm.
So let's just go back to small business 25% tax rate. So when we deal with clients, we go, okay, are there people within your family structure where we can get the money to them so that they're earning 135, and that's you're basically on the same basis as what the company would be if the company had that money, because Division 7A comes about where a shareholder who's a business owner lets the company get taxed on the profits, but then takes the money and doesn't pay tax on that money.
Yeah.
That's how it all comes about.
Yeah, so it's just taking money from your company account and
not calling it a wage, not calling it a dividend, which is what you're meant to do. Because the laws are that if you do that, you're meant to declare that as income in your name.
Yeah. Which,
if your company earns $400,000 for the year, it's been taxed at 25%, so it's paid $100,000 tax. An individual earning $400,000 a year is probably going to be taxed around $160,000, $170,000.
Yeah.
They're about 35. At that level, you're around 35 to 37% average rate of tax. So that's a big difference.
Yeah.
So people want that saving, but then they want to use the money.
Yeah.
And that's where Division 7A comes about.
Yeah.
They're using company money for their own lifestyle when they shouldn't have.
Yes.
And then we have to come along and say, do you know that you're meant to now declare that as income in your name?
Yeah.
And therefore you've just defeated the whole purpose of having the company structure in the first place, if that was one of your primary goals of having the company structure.
Yeah. And then what happens later about having, 'cause obviously it's classified as a loan against yourself.
Yeah, it is. So what happens is it all comes down to circumstances, okay?
Use me
you
for an
owe
example.
that money back to the company.
Yeah.
So there's two parts to that question. If you make a complying Division 7A loan agreement, you've got 7 years to pay the company back. The company has to charge you interest, which if you haven't used that money for a tax-deductible purpose, so because some people will do that. Some people will take money from their company and go and buy an investment property. We can work with that from what we do in terms of managing the tax outcomes associated with that, so it's not costing the client a lot of money. But if you're just using that for pissing it up the wall, for lack of a better term, the company has to charge you interest.
What is that interest rate?
It's about 8.5% at the moment. It changes every year. But the company has to charge you interest. You then have to. Most people don't repay the company. We do a paper transaction and call a dividend to the shareholder, which then they have to include in their assessable income. But the companies had to pay tax on this interest that doesn't really exist. So I did a calculation for a client the other day. He was, we've had 3 conversations in the last week about just leave this money in the company until 1 July, and that gives us then 24 months to sort out any Division 7A issues, because if you take company money out in one financial year, you've got till May the following year to fix the problem or to deal with it, so to speak. And there are ways in which you can deal with it, and that's where we have the conversations with clients. But I told him the outcome if he took, it was about 1.2 million, and he needed about half of it because he wanted to do something else. I said, just wait till July. Because if you do that and you can't repay the money because of what you're using it for, it was going to cost him over the 7-year repayment term $220,000 in interest, which equates to about $65,000 in tax.
Okay.
So he would have paid $65,000 more tax. Simply because
he didn't wait.
Now he still may need to do that, but at least we've got 23 months. To plan and mitigate, and circumstances for him may change. And he said, "I've got some circumstances changing." I said, "Well, let's just give us time. Give yourself time."
So would you, if let's just say someone is pulling money from their company account, their accountants are not advising them that they need to do it as a drawings, or they're not advising that they need to start lodging in as a wage or whatever. What would be, obviously get a new accountant, but how, the reason why I want to talk about it is because I don't want people to go through the same thing that I went through. Right?
Of course.
So what would be some advice that you can give that to people who are just starting out that are pulling money from their company account that are registered as a P2A LTD? What would you be saying to them from the beginning?
Understand how it works. Understand and communicate with your accountant as to whether, at what level does that become a problem for you. Because
mine accumulated up to about $350,000 before any accountant even said anything to me, right? And then from that point, I was given very bad advice, and I did something that I still regret to this day, but it cost me a lot of money, and there was a lot of financial hardship from making that decision. But I never had any accountants have any conversations with me and go, hey, you know what, this is a Division 7A loan. This is how it works. You've now got to pay. No one even gave me the option to say that I could pay it back to the company over a 8% interest rate, whatever it was back then, over 7 years. I never had that option. It was never given to me. The only option that I had was to liquidate. And that ended up costing me about $60,000 to $70,000. And it took 2.5 years. Couldn't borrow any funds throughout that whole period. It was the worst of the worst, but no one had that conversation. So I think it's super important that people know that, hey, you can actually pay it back over 7 years. And to recognize that if you are pulling money from your company account, that you need to be doing something about that, but also just making sure that your accountant is actually having discussions with you about it.
And that's all part of what we do for strategizing. And I guess it's important for people to understand that if you draw that money from your company and it's recorded as a loan, if the company takes a turn and goes south, you're now an asset to the company. So when you go, like in your situation, a liquidator comes along and goes, we're going to recall now all the assets of the company. Guess what one of the assets is?
Me.
A loan.
Yeah.
What did you use that for? Oh, I went and bought a property. It's got $500,000 equity in it. Okay, liquidator comes and takes that.
Yeah.
Or they ask you, they'll sell you up
Yeah.
to repay that loan.
Yeah.
So
it was such a dirty transaction. It really was.
Yeah.
It was, yeah.
So there are ways in which you can manage
Yes.
the debit loan account and be advantageous to the individual.
Yeah.
And that's advice that we chat to clients about specifically.
Yeah.
Making sure that the company is flush of funds annually is probably important.
Yeah.
Even if you want to use those funds for other purposes.
Yeah.
We do have strategies around that.
Yeah. Which is important. I think this is the importance of having an accountant that you can have those conversations with or ask those conversations. I think the purpose of this podcast is to be able to say, you know, people do make mistakes in business. Like I'm 6 years in and I've made a lot of financial mistakes, but if you have the right accountant, there's always another solution for you instead of liquidating or going bankrupt, if that makes sense. So always having those and having open discussions with your accountants too and being really honest about what your financial situation is important as well, I feel.
And being realistic too. In a capitalistic society that we live in, there are always going to be winners and losers, unfortunately.
Yeah.
Because that's just the way it is.
Yeah.
You know, roughly
I remember you saying this to me too when I came in. You're like, you know, you might just have to close it.
Yeah. Roughly 8,000 businesses a year go into liquidation.
Yeah.
So if you unfortunately, and sometimes it's circumstances beyond your control.
Yeah.
Sometimes it's just circumstances the person should never have gone into business.
Yeah.
Like you asked before, one of the questions you sent me was, you know, why do businesses get in trouble?
Yeah.
And it's usually not the business expenditure, it's the personal expenditure.
Yeah.
And then it's using, not having the budget for, not understanding enough about tax and everything like that, about the business profits to be able to go, we need to set aside that. And then not reining in personal spending.
Yeah.
Or going to buy the $1.6 million home because you think you've got 200 grand disposable income when really you've only got 150.
Yeah.
And all of a sudden the 1.6 should have been a 1.3.
Yep.
That's probably the biggest issue.
Yeah.
You know, we don't have a system where, like I said, there's not a lot of financial assistance outside of the individual owner to help you at the start.
Yep.
You've basically got to prop it up yourself. And so you want to be running lean and mean in the initial phases.
Yeah.
You have to get your hands dirty and do a lot of the work until you get to a point where you can leverage off, start to have staff, you know, start to use technology and everything like that to leverage off your work. But those initial years, you've got to go into business understanding that you're going to put in the hours.
Yeah.
But hopefully if you do things right, the rewards come in the future.
Yeah. Later. But it was I remember having a conversation with you when I came in that day and we were talking about my clinic and talking about you were just giving me some options. Either, you know, you run with it all the way through and then come out the other end, or we do something about it and close, essentially. But there were conversations, and the thing for me is that I was just I've been really stubborn with this journey as a business owner, just not wanting to fail, like just really wanting to push through, and the financial burden of that has been quite severe for me. But even to the point now that I look back, now that the clinic's going to be whatever, now that I look back, even when you saying to me, you know, why are you paying these girls as much as I was paying them? Have you thought about, you know, getting rid of them and going back in and doing it, or hiring someone for cheaper? And I just couldn't wrap my head around lowering my expenses to be able to make my profit margins bigger at that point in time, because it felt like failure. Like I was just like, I was trying to push so hard, but my expenses were just so fucking high and my profits were so low, but I didn't want to, like, you're in business to make money. There's so many other things that you need to look at besides, and what I should have done in that point in time is that I should have got rid of certain staff and I should have changed my business structure, and it probably would have been a different outcome for me. Yeah. But we just sit there so proud trying to make shit work when sometimes it just doesn't fucking work. Like it really doesn't work, and you got to step back from that and go, you know what, this is not working for me. Like, how do I get out of here? What's my exit plan? And I spent like 3 years just going, nah, I can do it. And I finally got to a point where, you know what, I can't.
Yeah.
That's enough for me.
Yeah. I had an inherent fear of failure as well.
Yeah.
All through my period of time. And like I failed in a lot of things. Failed in marriage.
Yeah.
Failed in like, you know, a lot of sports.
Yeah.
You know, business I've been quite successful with, but a lot of that was luck.
Yeah.
You know, at the end of the day, and
like
getting into an industry that's incredibly boring.
Yeah.
That not a lot of people do.
Yeah.
And that has repetitive work like
Yeah.
every year. You know, there's quite a large taxation and everything.
Yeah.
Like
There's
that.
demand there.
But you know, a lot of social things in life I've been successful at.
Yeah.
Terrible skier.
Yeah.
Like, you know,
Wow.
can't do that.
Yeah.
But
It's weird. It's like that mentality of, oh, I don't want to fail, even though you're suffering so badly and you just can't get up. A lot of business owners just constantly push through until the end, and there's just nothing left.
But at 45 now, or 46 now, but it was about at 45, it's just gone, you know what? You can't control any of that.
Yeah.
You know, and really, there's no scoreboard at the end of the day in life to say what you succeeded in and what you failed in.
Yeah.
Because at the end of the day, we will move on.
Yeah.
The next people will take our place.
Yeah.
And I think I heard a good quote, you know, you're forgotten pretty much about a couple of weeks after you're in the ground. I know that sounds sad, but unless you...
It's true, though.
Yeah. I mean, you know, unless the real close people like your wife or your
Yeah.
kids or everything like that, most people generally, you know, once the funeral's done and the procession's done...
So sad.
It is sad, but at the end of the day, you've got to come back to go, okay,
Yeah.
no one's going to give a fuck
Nah.
in 5 years' time whether I succeeded or failed. I have to make what's the best for me now.
Yes.
So I'm going to make these core hard decisions now, and I'm going to accept that that didn't work. It's not failure. It just didn't work.
Yeah. Yeah.
You know?
Absolutely.
A lot of things work. A lot of things don't work.
Yeah. And I think we need to, as business owners, really understand that if it's not working for us, it's our business, and that, you know, there are other people within that business that will probably suffer from what the choices that we make, but we have to put ourselves first. Holy shit.
And you make decisions easy. Like we hired an accountant a couple of years ago now. Within 2 weeks, we knew it was going to work.
Yeah.
And it's just basically, sorry, it's not going to work.
Yeah. I struggled with that. That
Tough
was
call.
really hard for me. Yeah. To just have someone hired and then get rid of them. I've always struggled with that because I want them to succeed within my business and I want my business to succeed, but not everybody is meant for you. Yeah. And that was a lesson learned as well.
You never double down on wrong.
Yeah,
Which
right.
is what a lot of people do.
Yeah. Oh.
So,
I've never heard that before.
hey?
I've never heard that before.
Yeah, no, it's one from one of my sports podcasters.
Yeah.
Yeah, he says it a bit because he talk about like mostly American sports is what I listen to.
Yeah.
But about you know, organisations running things back or keeping a player because they drafted them even though they might not have been the right person, so they'll give them a big payday in the end. When they should have let him go.
Yeah.
And, you know, his common phrase is you never double down on wrong.
Oh God, that's so true though, isn't it?
So if you get something wrong, cut it.
Yeah.
Don't double down on it.
I've been doubling down for 6 years.
You know, well, we all do because we all go, oh, we think we can fix it.
Yeah.
You know, or we think, you know, if I, you know, pivot.
Yeah.
You know, you might only have to pivot 20 degrees.
Yeah.
But yeah,
Yeah.
just go and do something else.
Yeah.
And strategize a different way.
Yes. Yeah. And what's a tip that you would give a business owner? Use me for an example. What would be one tip if you met me before all of this happened and I had the same business structure of what I do? Don't even consider the clinic, right? Let's just talk my credit repair company. Yep. What would be some suggestions that you would give me at the beginning to be able to set up my business profitably and make sure that I was... And even if it's something that you would tell me right now, like stop spending money, Lonnie.
Well, we don't know what you need outside of the business.
Yes. Yeah.
So it's budget.
Yeah.
Personal budget. And
yes.
go, okay, whether I'm employed or whether I run my own business, I need to make this much money to satisfy my own lifestyle.
Yeah.
And if you can't do that, then there's only ever two things that have to change. You go, make more money or reduce your costs.
Yeah.
I learned that too in business. Whenever a client comes to me, I always go, there's really only two things you can do.
Yeah.
You can either increase your money or decrease your costs.
Yeah.
If you can't do that, you've got to do that.
Yes. That is such a good tip, honestly, because for me, I took a really big wage at the beginning. Then, I keep bringing the clinic into this, but then the clinic came and I was paying myself like $600 a week, like barely living because I couldn't financially afford everybody else. That's what I was paying myself for about, I don't know, maybe a year and a half. And now that the clinic is almost gone, I've gone back to paying myself a good wage.
Yep.
But definitely it was probably only within the last 6 months I've actually sat down and gone, I need to figure out my budget. Because I am notorious for it, for just pulling money out of my company and whatever my set wage is for that week, not living within those means.
Yep.
And I've always been like that. And it comes down to financial, like being taught how finances work. Like I run a credit repair company, but that's different, right? We don't talk about finances. It's completely different. But for me personally, and I have no shame around this because it's going to be self-taught. Like I have to self-teach myself on how to budget and really work out what my expenses are. But there's a lot of people who have a wage and then pull more money out. But really it just comes down to making sure you have a budget. Like, and if whatever my budget isn't enough, then I need to make more money.
And it doesn't have to be a very detailed budget.
Yes.
It can be just general things like my budget now, my personal budget is based on what I know I spend on pretty much a credit card because I spend everything on one account, which is just a credit card.
Yeah.
But I know every fortnight what my max threshold is in relation to that. Yeah. And I know there's peaks and troughs sometimes with cars and all that. But I go, okay, over the course of 52 weeks, my average credit card spend per fortnight is this. Yeah. And as long as that is maintained, I'm not going to go backwards.
Why do you use a credit card though? What's
points?
Are you with Amex?
Frequent flyer points.
Yeah.
I'm with St. George, but it's got a good rewards program as well. Yeah.
Do you recommend that? Do you think it's good, beneficial?
It can do. There's other companies out there as well.
Like pay.com.
Pay.com.au. Yeah. It's I'm actually an investor on that.
Are you? Because I just signed up.
Very good.
Yeah.
Very good. Keep signing up. It's about to list in April.
Really?
Yeah. So it's been around for 6 years, but I think a lot of businesses, it's a different reward system. It doesn't tie specifically to Qantas itself. So the airlines and all that, it's partnered with about 20 different airlines. Yeah. I mean, I'll give it a plug, but being an investor and it's about to go on the share market. So it's grown significantly. It's a great idea.
Yeah. You're doubling up on points because I have an Amex Qantas card. So I'm doubling up on my Amex.
Yeah, plus running all that through. And with that company, you can actually run your wages, your tax payments and everything. Which I was
going to talk to you about, but I don't know if I want to do that yet. But we'll talk about that at a different point. But Because
you pay them the 1.8% or whatever, but then you get the points to be able to then go spend on luxury travel and everything like that, which you wouldn't normally get a tax benefit for. Yeah. So you get the tax benefit for the cost of the point versus without having the FBT issue of using those points to then fund a holiday.
Interesting. Plugging pay.com.au. Cool.
That's the whole premises around it.
Yeah. So. I'd love to talk to you about that too. We'll have to chat about pay.com.au. Cool. All right. This is the last part of our episode, but is there anything else that you'd like to give, any advice or anything like that before we finish up about?
Covered a lot off today and a lot of it more generalised. So, anyone listening or watching or however consuming this in their cars or whatever, which is where I consume podcasts, find a good accountant.
Yes, Aaron.
Yeah.
Get Aaron.
Be it me or someone else. But once you find a good one, really ask them any questions. Don't be afraid to ask questions. Yeah, absolutely. And don't be afraid to spend a little bit of money because you get the value in it. Yeah. In it, like anything. Yeah. Whenever you find good people in business, you stick to them. Yeah. And that's what we've tried to be for our client base and hopefully continue to be for a few more years. But having a little bit of financial literacy is important and getting that early and just getting your fundamentals right, from day one, your accounting system right, your structure right, and just getting reassurance, I guess, from your professional advisors. Hey, am I doing this right? Yeah. Are there any things you think I should be changing? Yeah. And, most of the time you may get, look, at the moment you're going okay, or we haven't seen enough, or, let's wait a little bit till the end of the year because, May, June is the big time for us to communicate things around taxation and whatever. Yeah. And strategies around that. Strategies are getting limited because of the government pulling back on certain concessions around superannuation.
We didn't touch on that either.
There are always ways and means in which we can find things. Like I said, episode 15.
Yeah, that's right.
Invite me back in. We'll delve deeper into some of these topics potentially. So,
yeah, definitely, because that's something that I wanted to touch on that. Anyways, we've run out of time.
Yeah.
I will be putting all of Aaron's details in the captions, bios, wherever it is. So if you guys are looking for an accountant, you can email his team and set up a conversation. But thank you so much. I'm thinking that I will get you back on probably later at the end of the year, and we can talk about some more things.
Yeah, there might have been some changes in laws then too.
Yeah.
That we need to delve into, especially around capital gains tax and whatever.
Yep, cool.
Government are going to try and rein in a few of our little perks. So
Yep.
we'll see how we go there. But been a pleasure, Lani.
Yeah, thank you so much. Appreciate it. Thanks.
Thank you.
Thank you.